Welcome everyone to the Gamma Optimizer Live for the week. As usual, the first question is, how is the sound? How is the video? So please let me know in the chat if sound is good or if something is happening. I hope it is good this time. Okay, sound is good. So let's start right away. We had an interesting week this week, suffice to say. So let's go with the closed positions. We don't have any single trade for this week. Ultra they provide us with trades, and which is good. No, sometimes it's better to be flat than being on the wrong side. I guess if we had opened any trades for this week, they will have been pretty much losers all the time. So it is good that we are not losing money on the trades, and I'm happy because of that. So no trades, that's good. Now let's look at the market regime. So the GT level, when I prepared the slides, the GT level was around 3,853 in the S&P 500. Clearly we remain short gamma, not by much. The imbalances have changed a little since I opened, but we are still short gamma. Short gamma means that hedging activity by option dealers will accelerate the moves. And the reason is because they are forced to buy if the market goes up, and they are forced to sell if the market goes down. Okay, so that's what is happening, and that's why we are seeing tremendous volatility. Other than the normal volatility due to the lack of liquidity in the market, we have additional volatility due to options dealers hedging their positions. And you know that every time that imbalances exceed 19 billion or 15 billion, they start to become meaningful. That's a lot of money. That's a lot of selling. So today we are seeing lots of intraday realized variance, and it's part of the reason we are seeing that is because the GT level is up and we are short gamma, and the other reason is that liquidity is absent. I don't know, I have no idea what was going on today. It's like pretty much the whole session since the opening has been devoid of liquidity. And that's very weird because the price action is not that bad. In fact, the market is green right now. The market is positive right now, and yet liquidity is terrible. So we have terrible liquidity with a market that is up. And even when it was down, it wasn't down by much. It was down by 10 points, 20 points. Nothing that is not that the market was crashing. So my only guess, if I have to advance any guess here, is that there has been some kind of rotation. There is a massive rotation happening in the market. So the selling pressure for the rotation is exhausting liquidity. But then the money is going to somewhere else. So the index itself, the basket, remains more or less stable, but the internal liquidity of the market is suffering, is straining. And this is a consistent theme for 2021 and 2020. Since the crash of 2020, liquidity has been an issue in the S&P 500. And this is something that I have talked before in my presentations. It seems that we are perennially short of liquidity. The liquidity providers are a species that is on via of extinction. No, they are about to go extinct, and it seems that we now have only 4 or 5 liquidity providers in the S&P 500. And those guys, if they don't like what they're seeing, they don't provide liquidity, and that's it. So we used to have a healthier environment for liquidity providers long ago, when they used to be called market makers. So when market making was a thing, we used to have lots of them, and they really did a great job of buffeting the market against big moves. But anyway, I digress, and the net takeaway is that liquidity is very low today and that we are still short gamma. In terms of volatility, this is realized variance. Realized variance for the past month has been kind of okay. It's increasing a little bit from last week. It's only 16% now if you round the number. It's not that high. Reality seems to be on the low side. Yet the same realized variance for last week is incredibly high. This, for the last 5 days since Friday, since last Friday until today is 24.8. That's massive amount of liquidity. That's a lot of realized variance. We flipped briefly long gamma on Monday, but since then we have remained solidly short gamma all week long, and it is really it has been the tail for this week has been that market has been short gamma and it hasn't been able to go back to long gamma, and it's bad. No, that is bad. Clearly, dealers now are a little more nervous than last week. Last week they were really sanguine. Now they are really nervous. The volatility is starting to move up all over the place in the curve, and it's also because of the short gamma regime. No, and I keep repeating this. For those of you looking for a return to normal, looking for the end of this mini correction period, let's go long gamma first. No, don't try to catch a falling knife. Let's wait for a long gamma crossing, because usually if the market manages to cross over the GT level, which is 3,855 right now, if the market manages to go back to long gamma and close long gamma, you know that all of the previous crossings have been good for hundreds of points. So this thing is going to be good for a lot of action. So let's see. Okay, let's hope that if we cross, then we go back to a normal action. But as long as we are short gamma, I still don't see how we can keep moving up. I still think we need to be careful in this area. And I have a question. And the question is, I noticed that the options bid-ask spreads were all over the place today with dovetails with your thesis of no liquidity. Yes, Jim, that's correct. I don't think that most people are making markets even in options. I don't think that that options players are making markets today, which is weird. No, we are up. Last time I checked, we are green, and yet they are not providing liquidity. And if there is no liquidity in the underlying, if there is no liquidity on the stocks, the options are even worse. Options per se, by definition, are very liquid compared to the underlying. And today, all of the stocks, all the underlyings, there is no liquidity. There is no liquidity for the basket. There is no liquidity for the options. Diving a little bit more into this, let's look at the term structure of S&P 500 options. And this chart, as usual, remember the blue line is the current term structure. The red line represents the term structure from last week. There is another layer there, I don't know. It is my data provider, which is crap, but it's the only one I have. And that's for next week. Is for a couple of weeks is the official March expiration. There is something there. There's probably some bad put that is terrible price and is making the thing really big. But other than that, notice that there is heavy inversion in the curve. We have backwardation in the term structure, and the market is heavily inverted with the options expiring today hitting almost 60% implied volatility. The ones from Monday at 35, and then the whole curve is approaching 30. Those are extremely high values of volatility. Dealers are finally repricing uncertainty into the market. The back of the curve is very elevated. I mean, the back of the curve is so elevated that there could be a trader, because if this thing normalizes at some point, the volatility from the back should drop towards the 20s or the 25s. I mean, you could extract some basis points in volatility if you think about a trade there. So we'll see. But for now, the curve is reflecting nervousness in the market. I don't know what is spooking the markets right now. We can always speculate about the reason for the spookiness, but the net takeaway is that finally dealers are catching up with the nervousness. Last week we saw it in the action from last week was really bad. Yet dealers were kind of on the easy side. They were not worrying too much, but this week they are worrying. And I have more questions. I have a question that says that Ultra is showing a positive mean for next week. Does that favor market not dealing much next week? Well, yeah, so I'm going to talk about Ultra predictions when we arrive there, but in general, I like that the neural nets are positive. Remember that at the end of the day, the neural nets are not omniscient, they are not infallible, no? They are not all-knowing or powerful. They could be wrong. But one thing that I like is that because they are convolutional neural nets, we know that they are very good at finding patterns in things. And I guess in terms of Ultra in particular has been very good at identifying the weekly pattern. So what Ultra is telling us for next week is that they think the pattern favors, maybe at some point in the past there was something similar to this particular setup, and it favors a bounce into next week. So I like that. I do like that, and I plan to trade it. I don't know if it's going to happen. No, remember, there is no certainty if it's going to happen or not. But we can use the information to position in a statistical way. You know, we could design a trade that is statistically advantaged just because we have that knowledge. Okay, but it doesn't mean that the market has to go up, but at least it's positive. I have a question. Since short gamma equals volatility, does that have a bearing on the success or failure for all of the ULG VRP trades? Well, ULG and VRP trades, for those of you that don't know, are the trades that we do in the Gamma Optimizer room. And they are based on neural nets. And the answer to the question is no, it doesn't have an effect, because the signals for those trades come directly from Ultra. So Ultra already knows this. So volatility is already part of what Ultra is looking at. Without giving that much away about how the neural net works internally, but I'm telling you, both realized and implied volatility are fundamental part of Ultra. So they are already included there. So if there is a positive signal, it means that, yeah, we are going in. We don't have to add any extra features because it's already part of the prediction. So in terms of implied volatility, coming back to the slide, in terms of implied volatility, not good, doesn't look good at all. So let's look at realized variance. Again, the same thing. Realized variance is crazy. Not realized variance is the intraday value, is the blue line, and you can see that the blue line is going crazy recently and is shooting up. No, it's basically it caught up with VIX and is overtaking VIX now. So realized variance is an indirect measure of liquidity. Liquidity has been disappearing in March, which is really interesting. I find it very interesting because if you guys remember my presentation about seasonalities in realized variance, we know that March has high variance. It's a seasonal month with high variance. And then April and the summer, so it starts to decrease a lot towards the summer. So it's so interesting that it didn't disappoint this year. We are seeing really high variance in March. Personally, I don't think we're going to crash. No, I guess it's too easy to compare this period with the period in 2020 when realized variance started going up. You can see it just basically touched 80. That was the crash of 2020. I don't think we are. I don't think we are crashing. I mean, those are famous last words. No, I say this and then on Monday we crash on Monday. But from a statistical point of view, I don't think we are crashing. I will elaborate on that more, but I don't think one of the conditions for a crash has been fulfilled. If you notice in January 2020, you notice that both the blue line and the red line, which is VIX, were really low. Market was really calm. People were really exuberant, thinking that the market could be moving up. And then the crash due to the pandemic was a surprise, and then there was a repricing of risk, and VIX went to the roof, and realized variance went to the roof. Now, notice that VIX has never been below 20 anymore. VIX has always been kind of like right there predicting a crash, and now realized variance is kind of going up in the same shape than last year. But everyone is paying attention to this. I mean, it's too easy. It will be too easy. If like people say, oh, this is going to be the anniversary of the crash of 2020, then we are going to crash also in March. And I say market is never easy. And people are already starting to get nervous. Coverage in the mainstream media is nervousness. The headlines are always negative. There is concern about interest rates. There is concern about inflation. And when those things happen, the market never crashes. Just my internal rule, my golden rule is the market never crashes when everyone is expecting a crash. When everyone is looking for a crash, it will not happen. The only time the market crashes is when no one expects it. And this is not the condition right now. And I have another question. of the strategies that gave us data for last week, it seems to me that BRP50 was the best. Why don't you like it? I like it. I like it. Jim, this is related to strategies. Yes, I like BRP50. It's really good. I mean, and in general, if you do a statistical analysis, in terms of edge, any trade that is even money, if you have like a coin toss, no, any system that provides even money one by one is a great system, because any improvement on the probability, the starting probability is 50, and you increase it a little bit to 51, is giving you substantially higher edge in dollars, because it's even money, no? The opposite is also true. Any trades, like for instance, ULG 20 and 4, they are very cheap trades and they pay lots of money, but they have high failure rates. And you have to improve the odds massively in those to make the same money than BRP50. So even money strategies are fantastic if you can improve the odds. And I like it. I am not saying I don't like it. I like it. It's just that I don't have it for the room, because I am focusing on short gamma trades right now. But BRP50 is not bad, Jimmy. Jim, it's not that I don't like it, it's just that I'm not doing it publicly. It doesn't mean that I'm not doing it on my own secretly, no? If you get my meaning. Okay, so coming back to this. So realized variance is really rough. It is liquidity has been an issue for me. I don't know. I think that at some point there is going to be regulation in the market. There has to be a change in market structure, and we need to address the issue of liquidity in the markets. At some point, the regulators will have to step in and perhaps rescue and revive the concept of official market makers. Let's look at ambiguity. Okay, ambiguity is the black line and probability of negative returns is the red. So if you notice, ambiguity is doing nothing. No, ambiguity hasn't been doing much. It hasn't approached the 0.2 region, and this is one of the reasons I don't think we're going to crash. Compare the value of ambiguity right now when we used to have at the beginning of 2020. You notice that at the beginning of 2020, ambiguity was way above 0.7. No, it was really, really high. So you crash from high levels of ambiguity. Right now, ambiguity is around 0.17, very low. So I don't think we have seen crashes from those levels ever, no? Since I can measure ambiguity, even though I only displaying 2 years of ambiguity here. But if you go all the way back, you'll notice that the market never crashes with low values of ambiguity. So that's one of the reasons that I am, burning some karma here, saying that we are not going to crash next week. Okay, we could, of course, there is something, an asteroid could hit Earth. I mean, something could happen, and we could crash. But at least from this kind of measures of the market in terms of ambiguity and in terms of what is happening in the gamma imbalance and the short gamma regime, we are not going to crash from the short gamma regime. I mean, we crash from long gamma to short gamma, but not from when we're already short gamma. So ambiguity is a non-factor right now. That's kind of the takeaway of this particular slide. For the trade plan, well, I think now that we are seeing tremendous variance, and that the realized variance is catching up with VIX, well, it makes no sense to BRP trades. However, Ultra has been so good that we had been on the correct side. I mean, Ultra has been predicting that we will have failed, and that's why we have not done them. But now, I think there is a good time. I think now one of those two things have to happen. I think that realized variance is going to normalize at some point, hopefully next week. So I like BRP trades. I'll take the risk, and I like the risk reward that they offer. So in particular, the one for 3 sessions, which is the only one that I like. The BRP for 5 sessions is too risky. For 3 sessions is the one that I like the most. So that's in terms of the trade plan. And then let's look at the variance center before going back to questions and see. So this is the variance center, and you can see that we have had a crazy day today. No, we have been up and down, I don't know, 140 points, 17 points, 70 points down, and a bunch of points up. It is interesting. And realized variance is too elevated. You can see realized variance intraday is 29.58. This is crazy. And at some point in the morning, around 10:41, we had 45% realized variance for the last 30 minutes. That's basically crash-like levels. That's basically liquidity disappearing completely, like no one making markets. This is pretty much what this means. So at least RB30 is coming back to 22, which is very elevated, but compared with 45 is low. And the total realized variance for the day is around 29, which is very, very high. It's very high. And you can see we are short gamma. You can see that we remain in a short gamma regime. And the imbalances are okay. So now notice that the imbalance up is only 7.5 billion, which is some money. So if the market moves up, there is some buying pressure, not much. I mean, 10 billion of notional is not enough to move the S&P 500. On the way down is a different thing. On the way down is massively imbalanced. The imbalance is 16 billion of selling, and 16 billion of notional selling is more than enough to move the market. So if for some reason the market starts to move down and dealers need to hedge, they will accelerate that move down. It's going to be interesting acceleration. In terms of the gamma imbalance, we have options expiring today, and this imbalance, the breakdown by strikes, the strike that is with the most is going to be an attractor of price for today for 4 p.m. is 3,800. But the problem with this is a short gamma imbalance, so it will accelerate towards 3,800, and if you buy overshoot it, and then 3,750 catches it. So I will not be surprised. I mean, the range by the close is going to be massive. It's going to be the 3,000. It's going to be 50 points or even more. I mean, the range is all the way to 3,700. These three hedging walls are in play today. Notice that on the way up, there is nothing much going on. There is some buying, but it's not enough to move it. And then it flips long gamma, and long gamma slows down everything. So the short gamma region is showing a potential close that is all over the place. And you can see here with the sigma ranges, no? The 2 sigma range and the way down is 3,739. So yeah, we could be in this area by the close easily. Okay, it's a very massive range because of the tremendous amount of volatility. I have a question here. How do you calculate if we are long or short gamma? Well, so for that, I calculate something that we call the gamma threshold level. No, so right now it's 3,854, almost 55. And if the market is above the threshold level, then we are long gamma. If it is below that level, we are short gamma. And that's by definition, the level is the level of neutrality when dealers are neutral. And now, how the GT level itself is computed? Well, you have to, that's a very complex computation. You have to take all of the options from the S&P 500, which is, they are around 15,000 options in total. And you have to compute, to solve for a particular level where the gamma of all the options is 0. Okay, you are solving for a 0 gamma on the options. And that's the neutrality level. And the reason for that is because, dealers usually hedge their books all the time. When the market closes, they are hedged. When the market opens, they are hedged all over the place. And if the market moves because of gamma effects, remember the hedge cannot be static. Even though they are hedged, the needs of the hedge will change because of gamma effects. So when gamma is 0, there are no effects, so they don't have to rehedge. They are, at least in that level, in that sense, they are neutral. But if the market moves up, then the gamma is a certain sign, and then gamma is a different one because of the way index options work. No, but it's a complex mathematical computation. I think I have a paper where I explain how, in general, it's computed. The heuristic to compute it is not that complex. It's just the implementation is the complex part. Okay, so this is in terms of gamma imbalance. You can see here, this is just the last period of the chart that I already showed, and you can see here how realized variance is going crazy. Is this chart here? I think that with this software you don't see my mouse, so You can see historically is the dark line and VIX is the light line, and you can see that we are going crazy in intraday, and VIX is barely reacting now. No, there is starting to react. Okay, now let's look at ultra, which is what everyone likes. Ultra is the favorite of everyone, it seems. So off the bat, the things that I like about ultra is let's focus on the mean column, this column here, the mean. And I like that because even though I keep saying this, in a perfect world, the predicted mean from ultra should be 0. No, the distribution should be perfectly centered. There should be no bias on the distribution. But there is a bias, and if you notice the bias, the mean for the last 5 sessions has been positive, has been strongly positive. Well, it was weekly, very weak, and then it started becoming really positive, and I like that. So ultra, at least ultra seems to be favoring upside into next week. No, although if you pay attention to the standard deviation, the uncertainty of the prediction is increasing. No, in particular today, is increasing a lot. It was decreasing during the week, but I guess given to what has happened today, it is increasing a little bit. But for now, the mean is okay. So I will say that it's not that the mean is too positive, but at least is neutral bullish. Let's say no, it's neutral with a little bullish bias, and that's why you see all these potential trades, all the ULG trades and the VRP trades are all positive. When was the last time that you saw everything positive? And for reference, for those of you that are new to the room, the only official trade that the room is doing is this one, VRP 203. So if you're going to follow a trade, follow this one. Also for reference, these trades are only meant to be done around 4 p.m., even after 4 p.m. Remember that SPX options trade until 4:15. So if you want to follow any of these trades, do them after 4 p.m. Also, sadly, for those of you that are not members, these strikes change real time. So who knows what the strikes will be by 4 p.m. They could be completely different to this. So don't use this as a reference for a trade that you're going to put later on. No, the best thing you can do is to check around 4 what the values are. But I think that they're very good odds. I mean, I think it's a very, very good trade. I like it a lot, and I'll take it. I'll take this trade. I plan to take this trade. I mean, whatever, just notice that the strikes already changed. So that's the only official trade. I keep the other ones are systems that I have done in the past and that I know some members like to do, and that's the reason they are there, because they want to see them, so I keep them. I keep the trades there. Okay. So in terms of ultra, at least that's the glimmer of hope. In a sense, ultra is giving us a glimmer of hope, and ultra has been very accurate. You know, guys, for those of you that are members of my room, you have witnessed firsthand how accurate it is. Now, ultra is actually very, very good. So I am using that as and informing my trades based on ultra. Okay, let's go back to the presentation, and we have questions. No, this was perfect timing. It's already half an hour in. That was all. So if you have any questions, folks, please let me know. Otherwise, thank you again for attending the meeting. I hope you have a great weekend. Even though the market seems to be in a terrible spot, at least our ultranet seems to be positive into next week. I don't think it's enough for me to go long with both hands, but at least it's good at least to do neutral trades and to start wetting my feet a little bit into the long side. So thank you again. I hope you guys have a great weekend. If you have any questions, please let me know in the room or send me a private message, or leave a comment here in YouTube or where you are. Thank you again and have a great day.